The RBI's Central Board has decided to transfer 28,000 crores to the government as interim dividend. While the amount doesn't raise too many eyebrows, some quarters have raised questions over the timing of this. The concern stems from paying a dividend before the year is over, and on the other hand, it is the amount that will help the government inch closer to its fiscal deficit target, helping it cut down on borrowings. So how should the bond market react when it opens for trade today? Let's ask, it's opened and we'll ask Manish Wadhawan, the MD and Head of Fixed Income at HSBC India. Manish, good morning to you. And, that's a crucial question because obviously the amount is not a big amount. While it was already indicated to us in the interim budget that the dividend from the RBI was expected at around 74,000 odd crores. Now that it has actually come in, does it give a little bit of a relief to the bond markets that the government borrowings will not have to be increased to that great an extent?
Good morning. I would just say, first of all, it's not a surprise at all for markets that this interim dividend of 28,000 crores has come to the government. It's on expected lines. It was already in the budget also. And what we have been seeing for the last 3 or 4 years now is whatever has been the surplus has been transferred to Government of India in 2 tranches. Even last year it happened, interim and the final dividend. I think 31st December, after the closure of books of RBI, half-yearly closure of books of RBI, they would have come to this conclusion that that amount is feasible to pay, and that has gone into the government coffers. Secondly, on the fiscal side, I don't think it changes at the moment anything in terms of what has been projected. With this and the divestment proceeds expected, what is going on at the moment, we expect that the current fiscal year fiscal deficit should be met at 3.4%, what has been put in the budget numbers. So frankly, it's not a surprise for bond markets. It's on expected lines, and I really don't expect much to change in bond markets because of this announcement tomorrow, because today being a banking holiday, I think bonds are not trading.
Manish, just the fact that, whether or not as a practice this is prudent enough to go ahead and include, the future earnings of the RBI and take it in advance. This is the second time this has happened, and whether or not this actually happens on a consistent basis going forward as well.
I think I would avoid getting into the political aspect of it, but on the accounting ground, it is quite possible and reasonably okay within the half-yearly accounts, if they are closed, that you can give an interim dividend. See, anyways, I think there is a committee which has been formed to take into consideration what kind of reserves RBI should be carrying on, and we'll get a report by April. That's a bigger question and a separate one. But as far as this part is concerned, I think this is quite apt and there's nothing wrong in it. Rather than giving a full dividend of say 55,000 or 60,000 crores in August, if you pay partly in February and partly in August, because the overall amount cannot change. Coincidentally, this year the RBI operations on the FX and the repo markets would have given them actually even more profits because of the developments which happened in the FX markets. So I think from an accounting point of view, from timing point of view, it really doesn't make any difference. Yes, definitely it supports the government's fiscal situation at this moment, and again I would repeat, it is not impacting the bond markets or bond market yields because of this. It is not a very significant thing. Just imagine the total amount of budget, what we're talking about is something like 28 lakh crores. Within that, this amount is minuscule, 28,000 crores. So it would have come in, August, as you said, that if you had taken the full year interim dividend versus the interim dividend, but it is being partly divided into 2 parts, February and August.
You also alluded to the fact that there is the Bimal Jalan committee, which has been formed to discuss the quantum in the contingency of the RBI. Just the fact that the last few years there was a contention that the RBI kept aside more than it paid out to the government in the form of dividends, and this probably could be a clawback of that and should not be read as to anything bigger than that.
So what's your point?
No, would you agree to that? Would you agree to that this should not be read in any other fashion?
I think there is, yeah, sure. I hear you. Frankly, I think one should segregate this interim dividend payment with what the Jalan committee is going to do. Interim dividend is nothing but this year's surplus being given to Government of India, which RBI will have, it's on the same lines. As far as the old part is concerned, I don't have the skill set to even comment on that kind of a thing. That let the committee look into it and come with a report. Frankly, if you look at the balance sheet of RBI, it's constituted in a very different kind of manner than a corporate. When we talk about contingency reserves, when we talk about the reserves on account of the FX intervention, etc. Maybe they'll have a new look towards that. But I remember Governor Rajan saying that for the last 4 years, since the time he took over in 2013, they have been transferring all the surpluses for the year to Government of India. So that has been going on. I think what this committee is looking into is historically what RBI has been keeping with it, whether they should do it or not do it. I think even in theory, if you look at it, there is no equal parlance available in the developed world and developing world. All the balance sheets of central banks have different kind of parameters, and it is not a simple comparable situation that this is ideal and this is not ideal. In my view, I think we'll have to wait for the committee report, and I really don't have any strong views about what is right and what is wrong at this moment.
From the bond market standpoint, you made your views pretty clear in your first answer. But just the fact that you've not seen much of a move since those pre-budget yields around 7.36, 7.37, they're pretty much hovering around the same range. What do you think is going to impact meaningfully, if at all, in the near term?
I think you made a very valid point. If you look at the pre-budget yields and if you look at the post-monetary policy yields also, where a 25 basis point cut has happened, the 10-year average yield has been hovering between 7.25 to 7.40. We have not seen any major impact on bond yields because of this, because the future borrowing program, which is so large, as we know the numbers, it's around 12.5 lakh crores for the next year, including state and center. Markets have already started factoring in. I think what has happened is the short end of the curve has come down a bit, and that has given some kind of help or support in lowering the yields at 3 months, 9 months, CDs, CPs, etc. But the medium term or long term borrowing costs have not come down either for the government or state government or even for the corporations. So I think overall, as of now, we are in a neutral kind of a zone. Even if market is expecting a rate cut in April at this moment, the long end yields will just be hovering around the similar levels unless and until we break through a barrier which is 6% on repo rate. Why I'm saying 6% is we started the rate hiking cycle last year from 6% to 6.5%, and then we are just about to go back. So, as analysts have been pointing out, it was a shallow rate hiking cycle being reversed. Unless and until the dynamics of macroeconomy change and we can think about larger rate cuts, as inflation is very low, it's going to stay under that 4% radar for a very long period of time, then you could see a material impact on bond yields at the long end also. If that does not materialize for some reason, then don't expect any kind of larger moves. It's becoming the curve is going to be steeper. It's an investor driven market, and they are factoring in the long term trends, and that is why long end yields are not coming down. Lastly, I'll make a point I just read in the paper today morning. The State Bank of India chairman mentioned that there is little scope of bringing down interest rates at this moment. So there is this tug of war going on of transmission of this rate cut. What can happen next? What would happen? As of now, long end yields might remain stable. Maybe we need to wait for the next government or some other things to take a call beyond that.
Interesting. Manish, do any of these two factors play in your mind currently? One, whether post a very cold winter, if we have a very hot summer, a subpar monsoon, and what it does to inflation. I know inflation has been stubbornly low despite everybody believing that at some point of time it will perk up. But is that a factor that plays into the mind at all right now? And two, what if the talks between US and China don't quite work out the way the markets seem to be factoring in right now, and there are reactions on the yuan and therefore on the other currencies. How big a risk or a factor is that?
I think first point which you raised, inflation. Inflation has definitely shown a trend which is we are also surprised at, but yes, there is something which is materialized in the food market, in the agricultural market, where the prices are not going up at all. And only yesterday, I think our economist, chief economist, came up with a paper wherein the convergence of the core inflation and the headline inflation is the new theme, what everybody is talking about and working on. In fact, I think it's a very interesting point to see what has happened in the last 1.5 years. We have seen, for certain reasons, that the agricultural prices are completely subdued, but on the core part, the inflation has shot up and it's been hovering between 5.5% and 6%. The reason being touted at the moment is because of one-off factors which are happening in health or education and even the GST. And the expectation is that the core would come down over a period of time. I am saying 6 to 8 months during this 2019 calendar. And agricultural prices also shoot up a bit as they normalize. So you would see, as of now, the expectation is that the inflation would be around 4% and not beyond that also. In that regard, there is no reason to worry on inflation. I think it's a chugging along kind of a path, and there is a high possibility of a rate cut being delivered in April. So inflation is not a worry. What we are only talking about is how much is the credit demand, how much is the deposit growth, how would the government borrow these kind of large amounts, and how much system does have the capacity to absorb all this supply. Because FPI flows have been quite muted for the last 3 months. If FPI flows start coming in, you could see some kind of a push, but otherwise it's more of demand supply game which is playing out in the markets. Second point, regarding the US-China thing, I don't think so it's going to impact markets in terms of the bond markets in India. I think prime reasons are 80% local here, 20% it could be others. I think the key factor to point out internationally would be oil prices, which have inched up quite a lot. They're up around from $52 per barrel to something like 66 on Brent. I think these factors play a very important role, which we would like to watch.
No, Manish, actually, sorry.
US-China trade outcome, it's a binary outcome.
Yeah, it's a binary outcome. No, my question was more from the currency markets perspective. Now, if the People's Bank of China drop the dollar reference rate once, and if the talks don't go ahead as planned and Trump being Trump does the unpredictable, and if China were to react, the People's Bank of China were to react on the yuan, does that bring about a resultant repercussion on the other currencies, including the INR? And does that change the dynamics a bit? Is that a factor that is being considered right now at all?
As of now, I don't think so. The markets are factoring in this kind of an outcome, and we really don't know what would be the outcome of this. But as far as USD INR is concerned in this quarter, typically the FDI flows are pretty reasonable, though we are not seeing, we are seeing FPI flows being muted. I would not expect rupee to move beyond a range of 70 to 72. I'm talking till March end, and then we'll see as the financial year begins. Because there are a lot of hedging activities, there are a lot of pending FDI flows which are bunched up in this quarter. So I think it's a balanced kind of a quarter. We have seen rupee in the range of 70 to 71.5 for the first 2 months now till 19 February. And I expect this range to stay till March, unless and until what you're suggesting, if something really blows up on the other side, it will definitely impact rupees. But on the flow side, I think it's quite balanced for this quarter.